Welcome to the Deep Dive. Today we're focusing squarely on Haverty Furniture, ticker HVT, and the latest Q3 2025 earnings call.
That's right. The results dropped after market close, calls the next morning.
And the initial market reaction was, well, pretty enthusiastic, big intraday pop on the stock.
Definitely got some attention.
So our mission today is to cut through that noise, figure out what really drove that excitement, but also, maybe more importantly, what operational tensions might still be lurking under the surface.
Yeah, temper that bullishness, perhaps.
Okay, let's unpack this. What were the raw numbers that got investors initially so fired up?
Well, let's hit the headlines first, because they really did deliver a pretty powerful beat, pretty much across the board.
Go.
Revenue came in at $194.5 million. Now, that's a solid 10.6% increase year over year.
10.6%, wow.
Yeah, and it comfortably beat consensus estimates by, I think, over $11 million.
Okay, so strong top line. What about earnings?
GAAP EPS landed at $0.28. That easily surpassed expectations, which were hovering somewhere around $0.24.
So beat on top, beat on bottom.
Exactly. But the real story here, the thing the market just instantly grabbed onto, was that return to top-line acceleration.
Right.
They reported positive comparable store sales of plus 7.1%.
7.1% in furniture.
Yes. And total written business was up 10.0%. Now, what's fascinating here is management explicitly said this quarter marked their first positive delivered and written comps in, quote, several years.
Several years. Okay, that context is key.
For a sector that's been battling, massive post-pandemic headwinds and slowdowns, that 7.1% is huge. It signals maybe a potential structural pivot.
A 7.1% comp, yeah, that's definitely an outlier result right now in this space. But, you don't get that just by unlocking the doors and hoping for the best.
No, absolutely not.
So how did HVT specifically engineer this? What were the drivers?
It seems like it was very purposeful execution. First, you do have to acknowledge some seasonality. Labor Day was highlighted as their largest event of the year.
Okay.
And that drove written business up 13.6% over just that 4-day period alone.
13.6. Just for the holiday.
Yeah, huge lift. But the underlying strength, it seems, was more in the quality of the sale, not just the sheer volume of people walking in.
Right. So they weren't just chasing foot traffic necessarily.
Well, traffic was positive, to be clear, up in the mid-single digits, which is good.
Okay.
But the average ticket was the real powerhouse here. It spiked 6.1% overall, reaching $3,668.
$3,668. That average ticket suggests they're really succeeding in selling higher-priced stuff, more profitable merchandise.
They absolutely are. And this ties directly into their big push on the advisory model, their design business, where customers work with their professional consultants.
Yeah.
That now accounts for 34.2% of total written sales, almost 35%.
Wow.
And that segment, well, it commands premium dollars. The average ticket for those designer sales, it ream even faster, up 11.9% to nearly $8,000.
$8,000 for the designer average ticket. That's incredible. That points to a very specific customer.
It really does. They mentioned focusing on that more affluent base, households with incomes over $150,000.
Right. Makes sense.
And they're selling full room solutions,
right.
Not just, a single sofa here or a table there. It's a fundamentally different approach.
But with that kind of high-end advisory model, they must be banking on high conversion rates, right? Turning those consultations into sales.
You'd think so. And this is where there was maybe a small caveat that needs mentioning, just for balance.
Okay.
While they did see continual improvement in conversion rates compared to Q2, which is positive.
It's a trend.
Right. But the rates actually finished slightly down year over year, low single digits down.
Huh. So traffic up, ticket way up, but conversion slightly down year over year.
Exactly. It signals that while the people who do buy are spending a lot more, they still need to get a bit better at closing the deal with all the positive traffic they're generating.
That's a really interesting nuance. Growth fueled by ticket size, but still some operational work on closing ratios. Okay, let's pivot from the top line then. How did all this flow through to profitability? Did the strong sales translate to margin expansion?
Well, the gross margin story was certainly robust. GM held pretty strong at 60.3%.
60.3.
Yeah, ticked up about 10 basis points year over year. So holding the line, slightly improving.
And what drove that?
They pointed to improved product selection, better pricing discipline, likely tied to that higher ticket, and that profitable shift in their sales mix towards the design business we just talked about.
Okay.
They seem to be managing product costs effectively.
All right.
There was a small LIFO accounting adjustment, but at 624K, if you exclude that, the margin would have been slightly higher, 60.6%. But operationally, yeah, their sourcing and pricing teams look like they're delivering.
Okay, so gross margin looks solid. Here's where it gets really interesting, though, and maybe where some of that initial investor excitement got tempered a bit after the first reaction. The selling, general, and administrative costs, SG&A.
The expense line.
While revenue grew, what was it, 10.6%?
Correct.
SG&A expenses jumped 11.3%. That's an $11.4 million increase. So cost growth actually outpaced sales growth, which obviously puts pressure on the operating margin.
Yeah, and this is the purposeful trade-off that management really hammered home on the call. They framed this SG&A increase entirely as a necessary targeted investment for future growth.
Okay, investment. But how do we know this isn't just costs running a bit hot, maybe spending, chasing demand rather than strategically leading it? What happens if sales momentum slows next year and they're stuck with these higher costs?
That is absolutely the core risk the market is likely weighing. Management tried to get ahead of that, though, by detailing pretty specifically where the money went.
Okay, like what?
The biggest piece was a $2.8 million additional investment in advertising. They highlighted their first direct mail campaign in several years.
Direct mail. Interesting.
Yeah, and also significantly higher spending in their really critical new market, Houston.
Ah, the expansion market focus.
Right. They also cited higher administrative costs.
Yeah.
But that was apparently largely due to incentive compensation.
Yeah.
Because the company is actually hitting its annual targets this year, unlike last year.
Oh, right.
Yeah.
So they're paying out bonuses they didn't have to pay last year.
Exactly. Which, makes for a tough year-over-year comparison, but it's fundamentally a good problem to have, result of performance.
Okay, so some of the SG&A jump is actually tied to success, but that marketing spend, that's the real forward bet.
That's the strategic piece. And management was quick to try and provide a roadmap for leverage there. They explicitly said they expect marketing spend to sort of flatten out in 2026.
Flatten in 26.
Which, if they maintain this sales momentum, creates a huge opportunity for leverage, right? For sales growth to significantly outpace expense growth next year.
Makes sense.
And they gave us a really crucial specific detail here. Historically, for HVT, significant SG&A leverage really kicks in when annual sales cross the $800 million threshold.
$800 million. Okay, so that's the magic number the market needs to watch for. That's the tipping point for efficiency.
Seems like it. But, we also have to place all this in the context of the broader economy. The call didn't ignore the macro headwinds.
Right, like high interest rates, the housing market.
Exactly. High rates, rising home prices, restricting housing turnover that usually fuels furniture sales, geopolitical stuff. All acknowledged.
Yet, despite all that, they still pulled off that 7.1% comp.
Right, which goes back to that focus on the more affluent customer who's maybe less sensitive to mortgage rates.
Sure.
They also had to address the supply chain and trade policy stuff, specifically the new Section 232 tariffs.
Ah, yes, the tariffs. What was the latest there?
These apply to upholstered wood products from several Asian countries and also Mexico. They were finalized at 25%.
25%. Ouch.
And they're set to escalate again to 30% in January 2026.
That's a potentially huge hit to margins. How are they planning to deal with that?
The response sounds like it was pretty rapid. They implemented targeted retail price increases back in early to mid-October.
Already done.
Apparently. Specifically to offset these tariff costs, maintain their margin structure, but also trying to protect the overall value proposition for the customer. It's a balancing act.
Delicate balance.
And also, remember how they've been shifting sourcing away from China over the past few years?
Yeah, that was a big initiative.
That success apparently proved really valuable here. It actually enabled them to resume their specialized, high-margin special order business.
Oh, interesting.
Which is a key part of that advisory high-ticket mix. So that proactive sourcing shift gave them some operational resilience against these new tariffs.
Oh, okay, that makes sense. Proactive moves paying off. Let's connect this resilience then to the forward outlook. Management must have felt pretty confident, right? Did they update guidance?
They did. They felt confident enough to actually raise the full year 2025 gross margin guide. It's now expected to be in an impressive range of 60.4% to 60.7%.
Raising GM guidance is definitely a sign of confidence.
Absolutely. That said, they also confirmed the SG&A spending is going to continue this year, lifting the fixed and discretionary SG&A outlook slightly to the $296 million to $298 million range. So confirming that investment thesis for now.
Okay, continued investment, but higher projected gross margins. And what about the balance sheet underpinning all this?
The balance sheet remains, frankly, pristine. This is
Right.
really the financial bedrock of the company.
How pristine are we talking?
They ended the quarter with $130.5 million in cash and cash equivalents.
Wow, okay.
They have $80 million completely undrawn on their credit facility and zero funded debt.
Zero debt, $130 million in cash.
Yep. Their financial discipline is, well, unquestionable. Year-to-date free cash flow was solid too, around $30 million.
And the board reacted to this strength.
They certainly expressed confidence. Immediately after the call, they announced they were raising the common dividend to 33 cents per share.
Nice little bump for shareholders.
Definitely a signal. Now, if we try to connect all this to the bigger picture, what does this signal about HVT relative to the sector?
Yeah, good question.
Well, this positive earnings print feels like a much-needed potential re-rating catalyst. You have to remember, HVT's trailing one-year total return coming into this was significantly negative,
Right, they'd been lagging.
badly lagging the sector benchmark, like the SPDR S&P Retail ETF, the XRT. So this resumption of positive comps, combined with that lifted gross margin outlook, those are the key ingredients for a turnaround narrative.
And they're growing again too, right? Store count?
Yes, exactly. They're actively resuming unit growth. They'll end 2025 with 129 stores after opening a third Houston location. And the plan is for 5 net openings in 2026.
5 net new stores.
And they've already got leases secured for key growth markets, St. Louis, Nashville, and actually 2 more in Houston. They are really doubling down on Houston.
Okay, strong balance sheet, returning to growth, positive comps, but still that SG&A investment weighing a bit near term, which brings us to that cash pile.
That $130 million.
And zero debt. That kind of financial flexibility, that optionality, it really demands a discussion about how management should deploy that capital for shareholders.
Yeah.
Especially while everyone waits for that SG&A leverage story to fully play out, maybe later in 2026.
Yeah, that's a fair point.
Okay, so now we move to the segment where we explore some of that financial optionality. Just a reminder, this is purely an intellectual exercise, us analyzing the options. This is absolutely not financial advice.
Understood. Not advice. But given that situation, the huge cash hoard, $130.5 million, no debt, strong free cash flow,
Right.
and the fact that the stock, it popped big initially, but then settled back down a bit, suggesting investors are still maybe a little nervous about the cost structure carry for the rest of 2025.
Yeah, that fade suggests some skepticism remains.
It suggests management is carrying, frankly, too much defensive cash right now. They're showing operational stability, those positive comps, the raised GM guide. But the valuation might still reflect some lingering fear or uncertainty about the timing of that leverage.
So what's the play?
Well, the trade idea is simple, conceptually at least. Force the market to immediately recognize the underlying financial strength and the capital return potential. Don't make them wait for 2026 leverage.
How?
Management could execute a one-time significant special dividend. Just return a chunk of that cash directly.
Okay, a special divvy.
Or perhaps even more effectively, from a signaling and per share accretion standpoint, launch an aggressive, accelerated share repurchase program.
More aggressive than what they have authorized now.
Way more aggressive.
Yeah.
They should arguably draw down a meaningful portion of that available cash, maybe say $50 million, for an immediate capital deployment event. Blow through the existing $6.1 million authorization.
50 million buyback or special dividend. That's significant.
It would provide that necessary short-term catalyst, force a re-rating based purely on the balance sheet strength and the capital return capability. It effectively bridges the gap until that full SG&A leverage story hopefully plays out later in 2026. Use the balance sheet now.
Interesting idea. Use the fortress balance sheet offensively while the operational leverage story develops. Okay, so stepping back, what does this all mean for HVT?
Well, Haverty's successfully delivered, I think you have to say, a strong top-line beat. The sales momentum is back, clearly driven primarily by that high average ticket and their successful design-led advisory sales mix.
Right, the quality of the sale.
Exactly. But that operational strength was definitely offset, at least in terms of near-term margin flow-through, by that purposeful, targeted SG&A investment this year.
The investment, they believe, sets the stage for leverage later.
Right, sets the stage for significant operating leverage, especially when or if sales cross that key $800 million annual mark they talked about. That's the target.
Okay, that sums it up nicely. So here's a final provocative thought for you, our listeners, to mull over.
Okay.
That whole discussion about the $800 million sales level being the key for SG&A leverage, It raises a critical question, doesn't it? Given that they are sitting on $130 million in cash and have absolutely zero debt, should management actually be far more aggressive with store openings than just the planned 5 net units in 2026? Could they or should they deploy some of that balance sheet firepower to accelerate growth and reach that revenue tipping point, unlocking maximum efficiency even faster?
Push harder on the growth lever now using the cash.
Right.
Interesting thought.